So good evening, everyone. Let me, maybe anybody has heard of deja vu? Deja vu, have you experienced deja vu, Amit? Multiple times. Multiple times. So let me give you my deja vu moment right now. Maybe back in 2010, there was a similar panel, maybe not so fancy room, etc. And the discussion was whether the alternatives industry in India will scale or not, right? And fast forward 2020, there was another similar discussion, and the question was how fast will the alternative industry will grow. And today we are sitting in 2026 already at 100 billion value of the alternative industry, and we are discussing the next phase of growth, right? So that's where we are. I think if you really look at how traditionally Indian economy has got funded, right, over a period of time, there was a heavy reliance on banks to fund the growth of the business, lending for the growth of the business, and government was relying on DFI capital for infrastructure growth, etc., right? But the playbook over a period of time has clearly been rewritten, right? If we see today, there's a lot more institutional capital that is getting allocated to different asset classes, real estate, infra, and private credit as well. And I think the real question is from here, what will take us to the next level? What all do we need to do, etc. Right? So this mystery we have with us, Mr. Amit Agarwal, CEO EAAA, who are the pioneers in maybe investing institutional capital across the board, across different asset classes, AUM of around 65,000 crore plus. So without getting too much of detailing, I think, Amit, the first question is, how have you seen this entire allocation of institutional capital across various asset classes, and what has been the real driving factor for that?
Hi, I think so. It's interesting because we keep going to a lot of global LPs and discussing this. But the fact is that the India's financial services industry itself is a very, very young industry. We are a sort of 30-year-old industry, started in 95, we're sitting in 2025, order of magnitude 30-year-old industry. So everything is new and everything is growing and everything is very different. So India's alternative industry actually started with private equity, and it was largely with global private equity players significantly. So when we started in 2012, if you see the alternatives AUM, whatever was there at that point of time, was almost 80-90% private equity, and other things were just starting about the whole thing. Standing today, our view is that the industry is more like $150 billion. I think there are multiple other aspects of adding a few other strategies which are like global players investing directly into India. So the overall alternatives AUM, I think, is around $150 billion, and the ratio has become 60-40. So 60 is what we call growth strategies, which is private equity and other stuff, and this is purely private markets. I'm talking of private markets. And 40% has become yield and income strategies, which is real assets, and whether it is infrastructure or real estate, private credit, special situations, all of that has become 40%. I think from a trajectory point of view, we are going towards a 275-300 billion sort of a number over the next 5 years. And it is nothing but a 20% CAGR. It's not as big a delta because even if we grow at 20% CAGR, we will be a $300 billion industry. And the ratio, I think, will move towards 50-50. It is more going to add in the yield and income strategies, I do think, will grow faster. And the growth strategies will also continue to grow, but there is enough space for everybody to grow. That's the good part of a growth market, because we are still a 7%, 7.5% growing economy, and not many economies of $4 trillion of size are growing at that rate. So despite all the people who say that India's economy is not as like global money should come to other economies, but we have our scale and growth.
No, very interesting, and I think as they say that the amount it took for the first number to get to 100 billion, I think you will take much lesser time probably to go to 200, 300. And I think these numbers look big, right? And I think the interesting question would be that where do you see some of the capital flowing into this industry? Is it domestic pool? Is it global pool? How are global investors currently looking at it in light of the geopolitical maybe scenario, in light of AI bubble or AI buzz, whatever we call in the US right now? So where are you seeing the real source of capital flowing into this?
So I think there's always a near home bias. You always believe that the flat in your same building is much more valuable and much more easily saleable in a building that is 10 kilometers away. So there is genuinely a human nature of having a near home bias. And so a Blackstone did not become Blackstone with money from Europe and money from Japan. Blackstone became Blackstone because of the money that it raised in the US. And I think you rightly said that adding the first million is always difficult and then it compounds. So India in its since independence, in whatever it added in 50 years that you would say, it would have added much more than in the next 25 years. So the same thing applies. I think the domestic capital is becoming a very prominent source of capital, and it will help seed new managers, it will help seed new strategies. But the global capital is also, I think, very, very fascinated by India. I think there are temporary phases where you don't get capital because there is either a currency volatility or there is a crisis like West Asia crisis where people feel that you are inherently dependent on oil and all of that thing. But I think I see the global capital coming back in. You're already seeing some amount of turnaround in the public listed equity markets. There is some positive flow which has started happening. We are seeing more and more inbound. We recently had a large European DFI anchor one of our funds. In another of our funds, we are seeing a lot of interest with very large domestic pensions and insurance companies. So yeah, the capital will come back. There has been a temporary period of last 1 year where I think the currency depreciation and others has allowed the global allocators to be a little bit more cautious. But the good part is that a couple of things have got established for global allocators in India. One, that if you give money, you will get your money back. I think that's something which has got established. A lot of funds have redeemed. We ourselves have redeemed billions of dollars to our global clients. So the investors now understand that there is a regime which is allowing a very sustained return of capital. It's not difficult to enforce assets in India. IBC has taken shape. So it's good, and I think over the next 6 to 18 months, we will see a lot more global capital flow back in India. The key is scale, I think, which Akash, my friend, also touched upon. I think they don't find actually scalable opportunities of investing in India, and that's why there has been a little bit of a challenge. But I think things like infrastructure, where there is a huge scale, they will continue to grow. Private credit, again, has a lot of scale. So as we get more scale, more capital will come in.
And I think you rightly said, and we've actually experienced it over a period of time, right? What goes also comes back, right? So when you pay out investors, then they are willing to give a lot more back. Again, I think as this industry will really go multi-bounds, etc., structurally, how do you see this industry spacing up, right? We are seeing a lot of consolidation in the US. We are seeing a lot more M&A happening in the US, where large fund houses are buying smaller fund houses, becoming big, etc. Do you see that structural change trend coming to India as well?
It's too early for India, I would say. I think still managers are building their track records. If you see the performing credit, I have not attended more performing credit after the COVID period than I have done in my entire career before the COVID. So it's last 5 years, I think, have been the maximum amount of people who have started their businesses, and some of them have not seen cycles and all of that. But I think consolidation is the nature of the industry. To give you a data point, if you go look at Preqin, the top 10 global asset managers actually get almost 60% of the total capital raise that happens globally. So I think it's easier for a pension or an insurance globally to allocate to a Blackstone than to, let's say, even an EAAA in India, because it's just easier for them to lend to somebody that's very well known, because it has no job risk for somebody who is investing government capital or a pension capital. So the large will grow large. I think that is something that will also happen in India. But it is very early. People are getting scale, and I think there will be asset managers who will gain scale over a period of time. There is enough space for everybody in the market. So I think we will see a lot more people coming up. I hope, as Akash says, that and a couple of other panelists before said that there are no big blowout accidents in the space, and I think that will allow a lot more managers to come in.
That's interesting. So changing gears a little bit, I think moving to private credit, which I know is very close to your heart, Amit. So So private credit again over a period of time has moved from niche to mainstream, right? And that's been the and what's been the reason? Is it more of the supply drain like NBFCs, banks pulling off the plug, or is it more demand driven where you're seeing maybe borrowers trying to have more flexible capital or partners with funds like yourself? Like what have you seen the reason for it getting mainstream?
So there's nobody who's pulling back in India, that much I can tell you. Everybody is only pulling forward. So there are no NBFCs or banks that are pulling back out of the space. Flexible capital has its own market. So I think India lends approximately $200 billion of capital broadly every year as of now. And I think the private credit lends 15 to 16 billion dollars out of that, maybe $20 billion. But it is within the 8 to 10% market range. While US is predominantly 50% of the market, there genuinely the banks pulled out of the private credit space, and a lot of private credit gained ground in that period. But now all the JP Morgans and Deutsches of the world are saying we are coming back into private credit. So I think there will be a little bit push and pull on that. But India is far away from that situation. We're still doing 8 to 10%. Almost 2% of that 8% is by recurring borrowers of a large conglomerate. But I think the fact of the matter is that there is enough space, and even if this 200 billion of lending annually goes to $300 billion, which is very easily possible, and this 8-10 moves to 10-12, then also you are seeing a very big move. Then you are talking of $30-35 billion getting lent annually on flexible capital. So nobody needs to pull back for private credit. What has made it mainstream is the confidence of the investors that the returns get generated, that the loss given defaults in situations is low, that at the fund level if I invest, I have a diversified risk pool. So even if one or two deals make a little less return, my overall returns will be higher. And I think all my friends and colleagues here who have done a great job in the private credit market to not allow any accidents. So all of that has allowed the industry to become mainstream.
Yeah, and I think maybe fast forward a little bit, what are the key tailwinds that you think will really get the private credit to the next level, and what one risk do you, and of course Akash did allude to some of the risks, but happy to get your thoughts that what is that one or two risks that you think the industry should be conscious of, aware of, where it comes to the growth in the private credit segment?
Too much tailwind is also a risk, but I think the fact is that I think from a industry perspective, there is definitely a need for capital. I think as the growth aspirations in India are large, this is predominantly financing growth in some sense. Let's say a segment is special situations where you are doing solution capital. So there are two big buckets in this market. One is financing growth and one is financing solutions. So there is a solution capital and there is a growth capital, and both have a space. Between them, I think the market will continue to grow, and as the corporates go, they will either need to finance growth or find solutions for themselves. So that 8-10% bucket, I think, is definitely, it will go by a secular growth rate of whatever the credit growth rate in India is. So that is definitely there. The risks, I think, is in credit, the biggest risk is to get complacent. I think the complacency that sets in with continued track record, because this is the only place where returns, see, people are coming to you for generating alpha. They are taking an illiquidity risk to generate an additional alpha. And if that alpha keeps coming down, I think that is a very big risk. If you become complacent, if some of your deals go bad, if you are not generating the alpha, because today a typical bond can give you 8-9% pre-tax, and I'm talking all numbers pre-tax. And if net of all the costs and all, if your performing credit fund is giving you 13, 12.5, 13, then you're creating an alpha onto that for the client. But for that, he is losing liquidity to that extent. So if your alpha keeps shrinking, then that is one big risk for you. You will not be able to generate the next fund or raise the next fund with the alpha. Second, I think, is any big changes in the, what I would say, the way enforcement happens. If you really work only on cash flow, and if you only work on counterparty, which we have seen in the past, where people put too much trust on counterparty, and cash flows are can be there, may not be there. But if you have, apart from counterparty and cash flow, if you are focused on collateral, I think that, but in times when there are too much liquidity, then people compromise on things, and I think that's something which the industry needs to be wary of.
And again, EAAA is one of the pioneers in this entire alternative space, including private credit. So where are you as EAAA seeing the maximum traction in this space? Like, is it more on structured finance? Is it more on private credit? Is it more on infrastructure growth? Like, where are you seeing the maximum traction currently getting built on?
So I think generally the yield and income strategies are generally overall having a lot of traction, where people can see regular distributions, regular yielding incomes. I think these strategies where you have to hold for 7-8 years the capital, and then at the end of the 10-year period you will get money. I think the public markets compete very heavily with the private equity markets in that sense. So I think these strategies where people can see cash flow are becoming better. We see, I think infrastructure is a very secular story. I think for the next decade or 2 decades, I think infrastructure will keep on going. You will have multiple areas. Government is still doing a lot of sale of assets, and there are enough people buying those assets. People are building platforms, selling platforms. So infrastructure is a very secular story. I think commercial real estate is also a very secular story. I think a lot of real estate, commercial real estate stories there. Special situations we do feel, which is the solution capital, will continue to be a long-term narrative. When I look at Oaktree, they have been doing special situation for like 40 years and generating the same sort of return for 40 years, but it's again a small part of the market, and performing growth credit, which is growth financing. These 4 I think are very, very secular yield and income strategies. Private equity has its own space. It's still 50% of the market. All said and done, private equity is 50-60% of the market, so that will continue to grow as well.
I know structurally and regulatory wise, I think there's a lot that's happened on the alternatives. SEBI has been fantastic. IVC has been pioneers in terms of getting some of these changes done. Do you still see there is still some maybe headroom on some changes, some big ticket structural change from a regulations or any other thing that can really bring that additional push to the industry?
So I think the regulators have been very proactive. They have listened to the industry. They have changed things for the industry. I think there is always room for more. where is there a room for more? I think we can always do with a little bit more facilitation. I think especially I'll come back from the 2 things which I think are very relevant and important is the depth of the market. How do we really build the depth of the market where secondaries can get traded, like even the AIF units now, they are getting dematerialized, and at least in our funds we see some over-the-counter secondary sales in a lot of those funds. So that market will get deepened, where people will be even able, so they have a illiquid investment, but the units that they hold can still be sold in the secondaries market. So that liquidity, and as and when more regulations come in and there are more clarity around how common reporting is happening, NAV is happening, and the regulations change around how we can get those reportings to a mutual fund level. So to that extent, that's if our reporting and NAV could be to that level, at some stage it will allow a depth in the market. So that's something that can happen. Second thing, I think IVC has also been representing with SEBI. I think as and when we can get into, like globally there are subscription line facilities or capital call facilities which ease investor drawdowns and distributions, which allow a very limited period of 3 to 6 months for capital call facilities, and investors can pay over a period of time. It smoothens the curve. Today the private credit industry sends money on any day and calls for money on any day, and most of the people don't have that sort of wherewithal to, nobody keeps that sort of money in a saving bank account, right? So there are a couple of things which can actually improve, and they will come as the time goes.
And any views on Gift City? Generally, what have you been hearing from investors overall?
No, I think it's a fantastic effort, and I think if the policy certainty for Gift City remains, which it has remained, it will become a good pool. We are already raising a couple of our funds directly into Gift City, where we are getting the pooling of capital at the Gift City level, and I think the more we are talking about Gift City and the more the things have remained same at Gift City level, investors are saying maybe it's a good consistent jurisdiction, and if that continues, I think it will become a very, very big pooling place for India capital.
Excellent. Again, no conversation in India can get over without maybe talking about Bollywood and India cricket. So if you were to relate the alternative industry to one Bollywood movie, which one would you think that would be?
Wow, I'm not. One Bollywood movie. I don't know, maybe Dhurandhar or something like that. I have no idea. But I won't have an answer for this. Sorry.
Okay. And very quick rapid fire. Domestic capital versus foreign capital.
I think domestic capital for the next, domestic capital, definitely domestic capital at this point.
Equities versus private credit.
Oh, that's a simple one for me. I think it's different. I think if you have 5 crores and you want to make it 500, please don't look at private credit. But if you have 500 and you don't want to lose any of that, maybe private credit is the answer. So it depends on how much money you have.
Okay. NBFCs versus AIFs versus ARCs.
Oh, I think NBFC, again, they are apple, orange and banana for whatever variety of reasons, but I think each has a different role to play. The NBFCs, if they manage their liability profile well, because they are permanent capital structures, it's a great vehicle. AIFs bring about that ability to modulate, ability to have patient capital. They are about patient capital and they can provide more flexible solutions, while ARCs actually solve a problem of resolution for the company. So there's really no choice as such, but since I am part of the AIF industries, AIF.
And close-ended funds versus evergreen funds?
So evergreen is any which way is a bad word. Everybody needs their money back at some point of time, right? So evergreen. So I think closed-ended funds are a very, what I would say, a very good solution, because it provides clarity to the people. But I think if there is enough and more liquidity and depth in the market, at some stage perpetual capital solutions are also very good. Like for example, the InvIT and REITs, you can call them as evergreen solutions, because InvITs and REITs are 30-year, 40-year products, and they are also differentiated strategies. Where is a fixed income product where you can get 13-14% sort of hold to maturity IRRs and some capital appreciation? These are InvITs and REITs. And we have seen, like our latest InvIT, which is CITIUS, which got recently publicly listed, is just like a perpetual capital structure. But again, very distinct risk rewards.
It's a different perspective. Yeah, absolutely. AI in credit or credit in AI?
See, I think AI is a tool and we all have to use the tool, but I think AI will be relevant. At least we have seen some of the things like the IC notes have become a lot easier to create. There is a lot more work that has gone on that, but I think it is something that we all have to grapple with. I don't think we are using it as much as we can, but AI in private credit is better. Private credit in AI is not something that is going to happen, because anything that gets of that nature, which is disproportionately valuable to the global economy, can get built only on equity money. Like internet got built on equity money, so even when the internet bubble burst, then also you don't have a problem. You get Googles out of it, you get the large Microsofts out of it. So all of these transformational technologies have to come on equity money. Credit is not part of transformational technologies. Transformational technologies, if you're doing on credit, you're having a problem.
Traditional lending options versus innovative structured solutions.
No, I think it's what you need at that point of time. I think there's no substitute for a traditional capital. Nobody here can lend at 7.5%. We borrow on our InvITs and REITs at 7.5%, 8%. Without that, how will those assets get created or assets get built? So there is a place for traditional capital, and then there is a place for special situation fund where you would lend even at the highest possible rate. So it's up to your need.
And asset backed versus cash flow backed, what would you generally prefer?
So I think we say that cash flow, collateral and counterparty are the basis of any credit decisions. But if I was to a gun was to be put to my head and say that if the cash flow is 100% certain, If somebody, it's like really, really certain, then cash flow based is better. But if there is uncertainty in cash flow, then asset backed is better. Especially in an inflationary economy, asset backed is always better, because if you just hold it for 10 years, and inflation will take your capital back.
No, man. Last, maybe rapid fire, Messi versus Mbappe.
Messi. Confusion. I don't have a confusion on that.
So thanks, I think Amit, you have been fantastic. I think everybody had a very great, insightful. Maybe we'll open for a few questions for the audience.
Yeah, do we have any questions? We'll take a few quick questions, 1 or 2 questions, anyone? Yes, can we quickly pass the mic this side?
So you said domestic fund versus overseas fund or foreign fund. So why did you choose domestic fund?
No, I said domestic. The question was domestic capital over foreign capital. So domestic capital has become much more relevant at this point of time. And today the global capital comes from institutions and pension funds. We raise a lot of global capital. It is good to have global capital, but the flow of global capital at this point of time is low. It will take 6 to 12 months before that capital comes back. When it comes back, yes, it's a great source. But since the questions have an answer and I have to give an answer, I have to say something, right? Otherwise, I would not choose.
Okay. So the cost of domestic capital versus the cost of.
I think both need similar returns. It's just that one gets rupee depreciation, the other gets tax. So both have the delta the same.
Operational cost of bringing those funds, cost of.
All of that is not material, because the money also comes in large chunks. Because a global investor will give you $200 million, $300 million, then the cost in percentage term doesn't matter. India distribution costs are no less. So the cost is not a matter actually.
Thank you. Thank you. Thank you so much.